Iran war versus the share price. There is Iran war that has been running for the last 2 or 3 months. Why is Kenyan market affected or falling because of this war, which is thousands and thousands of kilometers away? Number one, we need to ask, why are the foreigners fearful? All the investors, they hate uncertainty. They hate uncertainty. So the share is affected by fear. Is affected by fear. So when the share price will fall when there is fear, because people start selling to protect their money. They start selling to protect their money. Number two, the oil price rise, because Iran affect global supply of oil. Therefore, the demand goes high while the supply is small. Therefore, fuel becomes expensive, transport, manufacturing, inflation. And therefore, even those people who had some shares, they sell them to get money because there is inflation. Another thing, the third thing, which is the main, the foreign investors are selling shares. Like I know they have sold billions of shares from when this war began. Now I want to talk about three markets. I talk about three. We have the US market. US market is one of the developed markets in the world. So this market is not a small market. Then we have emerging markets. The emerging markets, they are market which those countries' economy is doing well and is growing. They are called emerging markets, like China, like Brazil. Those markets are unique. They don't have volatility like in our country. The share price doesn't move like how our share price moves in Nairobi Securities Exchange. It's a bit firm, it's a bit predictable. Then we have frontier market. This is where our Kenyan market lies. Frontier market. This type of market is for those countries which are trying to rise up economically, to grow. They are trying to grow. So frontier markets, they have high potential growth. However, they have the highest risk compared to US market. US market doesn't have that deep risk compared to frontier market. So what happens when the war, there is war in the world or war anywhere, the investors, because they don't invest 1,000, they invest billions of money. They sell their stocks and they run away from frontier markets. Frontier markets are affected first. Then they run to the developed market like the US or the emerging markets. So because they know the economies which are hit fast, or the market which are heated fast, are the frontier, like Kenyan market and the Kenyan market, Nigerian market, Egypt market, Tunisia market. Those markets, they are frontier markets. So they sell and they go and deposit their money in other countries where it is a bit predictable. So as they sell, because they sell a lot of shares, the share price start reducing, going down, a downward trend. And other people, they see that they are going to lose their money, they also sell. Then we have what we call panic selling. And because of everybody selling, the share price goes down. As it goes down, the market becomes bearish. And that is how the market is. But remember, let me give you an example. Equity was selling at 80 bob. It went away from 80 bob to 60 to 67, then back to 74. ACB was also at 80. It moved from 80 to 66 of today. Meaning they are selling you at a very good offer. If you never bought at 60, you can buy at 66. So what we call the safety margin of safety. You can buy now. In fact, wise investors, they don't buy. They don't buy when the market has a lot of noise and the market looks good. They buy when the market looks bad, like now. So what should you do? What should you do? You should buy. Thank you for watching.